Welcome back. I'm Bridie Barry. Our guest today, Roger Montgomery from rogermontgomery.com. The volumes that went through the All Ords, and they see nearly 6 billion shares in value changed hands today. Fortescue Metals there, the most traded stock, 75.5 million. Just looking at Fortescue though, I mean, any idea what's going on here? Or,
that's nonsense.
What's happening?
I mean, you know, it's great that they've sold shares because it increases liquidity. And whether the shares are liquid or illiquid, it doesn't change the value of the business. The forecasts that are bound about the future of this company mean that its intrinsic value, it looks like a hockey stick, you know, it really is steeply going up. But those intrinsic values are based on estimates that, you know, there's not going to be any speed humps in China. Things will look rosy forever. The iron ore price is going to just keep going up inexorably and we'll never see any decline. The reality is that there are some quite intelligent voices out in the wilderness at the moment who think that Fortescue, BHP and Rio are probably the three best opportunities to short sell in the world because of their exposure to China and the property bubble that exists there. So, you know, the selling may have something to do with their view that, you know, that this property bubble that we've seen in China, you know, is going to be something a bit bigger. I've had some people this week say to me, Roger, look, there is a property bubble in China. I agree with you, but it's confined to property. Well, you know, my response to that is, well, the earth is flat too. You know, that's, you know, the reality is the banking system has been lending money to property developers hand over fist, and the increasingly uneconomic returns being produced by property over there, that's going to come back and bite the banks, and it will become economy-wide. So my guess is that the selling could have something to do with that, but I'm just guessing. I don't know. We need to go and ask them.
Just looking at the banks then, I mean, what are your thoughts on the big four and which one's your preferred stock?
For a long time, I have preferred the CBA because the CBA is its purchase of Bank West, coming as it did, you know, from a distressed seller, if you like, and there was a sense of urgency about that acquisition. You know, if anyone compares how long it usually takes to acquire another business and get the relevant approvals, this one seemed to go through very, very quickly. I think there's a relationship between how quickly the CBA were able to acquire Bank West and the price that they got. So that means their return on equity is much higher than all the other banks. So I agree with the analysts that you were quoting that the CBA is the best performing business from a business perspective, a business economics perspective, but it is expensive at the moment compared to the other banks. And so I'd be reluctant to be too aggressive in buying the CBA at the moment.
And just quickly as well, I mean, we heard from the NAB too that it's denying it's going to be selling its Navigator investment platform in order to try and get the AXA takeover through past the ACCC. What's your thoughts on NAB and its value at the moment?
I think the ACCC have done NAB shareholders a huge favour, not allowing NAB to buy AXA at the price. AXA's trading at double its intrinsic value, and it's surprising, I know, but just as you and I might be tempted to pay over the intrinsic value for a company, and just as a retail investor might pay the wrong price, it's surprising how many CEOs often do the same thing. And I think that the ACCC, by not allowing the AXA bid to go through, have actually done shareholders there a huge favour.
So NAB's value now, it has fallen a bit since this happened?
NAB's price has fallen. Hopefully it falls further and it's below its intrinsic value, but it isn't yet.
Okay, all right. Let's just turn now to a special segment that we have here on Market Moves, Outperform. And this, of course, is where we ask our guest to pick a couple of stocks or sectors that he thinks are going to outperform the market or their peers. And you've got a couple for viewers tonight. Sure.
I'm a bit of a Cassandra normally when I come on because, you know, people say, oh, Rog, there's never anything cheap and, you know, everything's expensive. Well, that's true. It wasn't the case a year ago, or a little bit more than a year ago. In fact, everything was cheap and there were some wonderful opportunities. The reality is the market goes through its various cycles, and right now there's not a lot of things that are cheap. There's three companies that I like at the moment. They're high quality businesses. They're all what I call my A1s. They're the top ranking in terms of stability of balance sheet and very, very low probability of collapsing, and predictability of performance is also reasonably good. And so those three businesses, the first one is a perennial of mine, JB Hi-Fi, still looks good. Of course, if China... Really,
even though we've seen it sort of doing quite well recently?
I bought JB Hi-Fi at between $8 and $9 more than a year ago, and the value of the business has risen substantially, as has the price. The value continues to rise over the next couple of years. The value today for JB Hi-Fi is about $21.75, going to $26 or thereabouts next year, and then $30 or thereabouts the year after. Of course, that's subject to Australia's economic circumstances being quite benign, and nothing happening in China that would affect that. Of course, all bets are off. If something goes wrong in China, then my intrinsic values are going to be changing because the company's performance is going to change. So that's the first one. The second one that I quite like at the moment, again, an A1 business trading below its intrinsic value, is Oriton, run by Sally McDonald. I went to university with Sally, and she knows her stuff. And this particular business, again, same sort of retail, as you know, doing a great job, return on equity very high, little or no debt, and intrinsic value rising substantially over the next couple of years.
Mm-hmm. And I think you mentioned the third one.
I did mention a third. And the third one is right on its intrinsic value at the moment. It's not at a discount at all, and that's Nick Scali. It's furniture retailing, so most people will sort of lean back in their chairs and go, Rog, furniture retailing, tough business. But the guys at Nick Scali do a terrific job. Return on equity, again, very high. They're class leading. Out of all the furniture retailers, I think they're the best, if not very close to it. And again, another situation where the share price isn't trading at a discount to intrinsic value. It's right on its intrinsic value, but that value, provided they perform as expected, will continue to rise at a very good clip over the next couple of years.
Very interesting. Three there for us to look at. Roger, thank you so much for coming in.
It's a pleasure, Bridie.